Hello, everyone. Good morning, good afternoon, good evening, wherever you are. My name is Hoda Mehr. I am founder and CEO of the Stock Card, and I'm back with another 100-bagger series of stock research. This one is for Meta, or the Meta platform, formerly known as Facebook. And it's a very interesting one. It's a difficult company to evaluate whether it becomes a 100-bagger or not. But nevertheless, we're going to jump in, do our research today together, and figure out whether Meta can become the next 100-bagger or not stock. And so why even Meta? And why we're talking about Meta today? It's because, first of all, a lot of you guys, folks in the other votes have been asking for Meta. Second of all, I'm a shareholder in Meta. Actually, I bought it on the way down. So a couple of months ago, when the stock was significantly down, I bought a significant amount of Meta shares. And then I also own it through SPY. Anybody who is an investor in the broader stock market indices has a share in Meta. But what I found very interesting about Meta is that it is one of the most interesting companies that we can look at. Some people call it a train wreck, and some people call it extremely undervalued. So you see, it is one of the most uncertain and one of the most dividing the stocks out there in the stock market right now. It makes it a very interesting case, and we want to really figure out whether it's truly an undervalued company. We should dump a lot of money on it right now or not, or whether it is not. It's really sort of like a value trap. And based on some of the financial analysts, maybe it is a train wreck. So before we jump into the Meta's analysis, I have a little guest today with me in the studio. That's my dog Kratos, sitting under my kind of on the left hand of my desk. I took a picture, so if you hear snoring, it's not me snoring, it's Kratos. But thanks for joining, Kratos, today in the studio. Okay, so actually let's switch screen and get into the Meta stock card. And I want to show you something about it. Right off the bat, I don't know if you've noticed that on the stock card, we give this is sort of a new feature on our platform, and we basically take all of the data, all of the financial data that goes into that stock card, and we group them into strengths and weaknesses. And when I was telling you Meta is one of the most uncertain companies and dividing companies on the stock exchange, it's because of this. Basically, the number of strength factors and the number of weaknesses of this stock is almost equal. It just tells you how dividing this company is at the moment, because there's lots of good things about this company, and equally there's lots of bad things about the company at this point. So that's why it makes this analysis quite interesting. So let's go back to our analysis for a second, and let me make this bigger. Can Meta, first of all, let's just get the big elephant. Talk about the big elephant in the room. Can Meta even go lower than where it is right now? So right now the stock is about $96, $95 per share. So let's do this analysis. If its current income is about 4.4 billion, if we analyze it, meaning that we just take the latest quarterly income, net income multiplied by 4, we get a $17 billion annual income, right? Divided by number of shares outstanding in the company, and I'm assuming there's no increase or decline, it's a significant decrease in the shares outstanding, we get earning per share of 6.3. And then if we take the current P ratio of the company, which is about 8.7, multiply that earnings per share, we get a stock price of $54, right? So if nothing changes with the current status and how analysts are seeing this company as of now, the stock can still get half. The stock price can still go down significantly. So let's just be clear about that. This is stock. If anything, nothing changes about the economic status out there. Nothing changes about the situation of Meta as it stands today, the stock can go even further down. So yes, a lot of people say that this is a value opportunity, but it could also be value trap. We still can lose 50% of the market cap of the stock. That's a big elephant. Let's just agree on this. There's always, the stocks can always go lower than what it is. And for Meta, it is certainly a possibility. But putting that possibility aside, I want to tell you this: why analysts and financial community and media are so uncertain about Meta. What is going on with the company's status? There's as many bad situations or bad stuff about Meta as there are good things about it. So let's just paint this picture. What's happening with Meta at this time of the life of the company is that it's facing a significant amount of on the left-hand side, on the lower side of the balance sheet, it faces a significant amount of competition from platforms like TikTok or short format platforms such as YouTube Shorts and all other platforms, Twitter even being another competitor. So it's facing a significant amount of competition, and we see that in reduction or reducing hours engaged of the users of Meta platform with Meta's applications, right? If you read through their quarterly earnings, you see people are spending less amount of time on the platform, and that's because they have many other options to pay attention to. We have the Apple's privacy issue. So if you have an iPhone, you know that on your iPhone, Apple now asks you whether you want to share your information with this external app. So if you're accessing Facebook platform, for example, or Instagram platform, or WhatsApp, whichever of the Meta's properties, you have the choice of saying to your device, don't share my data with this app, and that means Facebook cannot track the performance of its ad or cannot target you as a person when you move out of its app, right? Which was one of the best ways Meta used to target ads or serve you ad, because they knew what you're doing outside their application. Now the Apple privacy issue is happening. People are worried about metaverse bets. So company Meta changed their name to Metaverse, and they're spending a significant amount of money, almost to the tune of $20 billion in annual on Metaverse. And we'll talk about this in a second. It's not only about Metaverse the way we think about Ready Play One, everybody's wearing the goggles and everybody's like in this virtual world, but overall the companies are spending significant under the umbrella of Metaverse. And then we have the economy's concern, right? Digital advertising spend is not growing as fast as it used to due to economic conditions. So those are things that are bringing the company down. And on the positive side, I'm on this right side of the equilibrium, the company is spending a significant amount of money on AI and machine learning. And this is important. When analysts say, oh, the company is dumping $20 billion on metaverse and this goggles and virtual reality, actually not all of that money is being spent on just the metaverse. Facebook is taking a significant amount of their dollar and they're putting into improving their basically recommendation algorithm. And what is that recommendation? And Mark Zuckerberg, I listened to the analyst earnings call the last one. He said it the best. He said, listen, before Facebook was all about your friends and your community. In your feed, you would receive things that are from your friends and your community. So Facebook knew this content is relevant to you because it's your friends and your community. Now it's not all about your friends. They need to serve content that is still relevant to you and who you are and what your interests are, but it's not coming from your friends. It's coming from strangers, right? So they really need to improve their recommendation engine in order to be able to serve you the right ad and the right content, put the right thing in front of you on your feed. And that's why the company is spending significant amount of money on AI and ML, machine learning and artificial intelligence in order to improve their recommendation engine. So that's a really good thing. You do want your investment, your companies that you're investing in, spend significant amounts of money on building their future, improving their products. They can't just sit down and not do anything. So that's a really positive thing. The other one is first mover advantage for Facebook, for Meta. So I know everybody is basically so against Facebook and Mark Zuckerberg is spending significant amount of money on metaverse, but no one on earth is spending $20 billion on the future of metaverse. And dollars will return into results. So if anybody is going to lead the race to launching the metaverse or anything similar to metaverse, it's going to be Facebook. Who is spending $20 billion annually on this initiative? So yes, it's a bad thing, but it's also a good thing. That's how companies break through, that's how companies launch new products. They spend significant amount of money and focus and attention and engineering time on things that they want to launch. So to me, that's not a bad thing. As an investor, I do want to see that investment. And the other thing about Facebook is that they have at least 2 or 3 times managed to change their product and kind of change their focus in order to generate more revenue. So when they moved from the desktop Facebook to mobile Facebook, that was also another significant change. And we know that they are sort of known for spending significant amount of capital on some things, and then it results into better results, right? So that's their track record. And last but not least, the company has just so much cash. So if you look at the company's balance sheet, I'm going to switch my screen here for you guys, and then we're going to look at on company's balance sheet and on company's financial strength here, and I'm going to show you how much cash this company basically has on their basically cash versus debt. So this is last fiscal quarter reported on September 30th, and the company has $53 billion, $53 billion in cash. Cash and cash equivalent. Cash and cash equivalents are, what are they? If you're not familiar with, these are things that are either cash or so liquid that can turn into becoming cash that they can spend on at any moment of time. So when I go back to this, we were talking about in a second, is that Meta, what's going on well for them is just they have so much cash to spend. They can still spend another $20 billion in metaverse and developing AI and ML and everything else, machine learning, and improve their recommendation engine, and they still have cash left in the bank, just in the bank, right? So it is true. Yes, everybody is just sort of bashing the company and say it's a train wreck, it's going down, and it's not going to be able to recover. But in reality, it is not true. It's a really balanced, it's one of those situations. There's a lot of good things happening and a lot of bad things happening for the company. So I wanted to talk about this with you first and kind of put that as a context as we go through evaluating whether the company is a 100-bagger or not, or where growth, even if it's not a 100-bagger, where growth can come from, right? Okay. If you're watching live, please make sure to put your comments in the comment section. Chime in. This shouldn't be me just talking to and be here and Kratos here snoring for us, but it should be a dialogue. If you have comments and questions, please jump in, and I do want to get to your questions soon. All right, but now let's go to our typical 100-bagger framework. If you're not familiar with 100-bagger framework, I use Chris Meyer's 100-bagger stock framework from his book. If you haven't read his book, it's a really, really good book, definitely worth reading. And I've been improving this framework over the course of years, over the course of months, as I've been doing the 100-bagger series. So the 100-bagger framework is a 7-part framework that is based on characteristics of companies that have achieved at least 100 times in return in the last couple of decades. And basically, we look at the company, whether the company has enough room to grow in terms of size. We look at, does it have consistent revenue? Does it have enough earnings? Can it generate enough free cash flow? Do we have a chance to buy that company at a lower valuation? How is the quality of the management, and does the company have any moat or competitive advantage? And those are the common characteristics of 100 baggers historically. So that's why it's a really, really good framework to evaluate any company that we want to evaluate. It's its ability to become a 100 bagger in our platform, in our portfolios. And so I've already obviously done the research for you, and I'm going to do it very quickly together. We're going to go through all these 7 factors and evaluate whether Meta can become that next 100 bagger or not. All right, let's switch screen and go to the company's stock card, and we're going to just get started right off the bat here on, let me make this screen a little bit bigger for you guys here so that you can actually see it. Okay, this is much better. So Meta, or Facebook, formerly known as Facebook, has a $260 billion in market cap. In order for this company to become a 100 bagger, to multiply 260 by 100, it needs to become a $26 trillion company. So right off the bat, it's just way too big for us to assume it can become a 100 bagger. So that's just something. Always consider the size and the amount of money or value market cap that it needs to generate in order to become a 100 bagger. So that would be a concern if I'm evaluating it from a 100 bagger point of view. The next thing we want to evaluate this company against is its ability to generate revenue, how fast it's been generating revenue, and how fast it's been generating profits. So on the revenue section, this is basically the last quarter, the September quarter that they just released in a couple of weeks ago, a couple of days ago. And what's super important for us is this growth rate, right? So the company on a quarter-over-quarter basis, it's been declining almost 4%. That's what everybody is so worried about. But if you look at on a annual basis, it's been up by almost 40% year over year. So that's, again, that situation of the company is one of the most uncertain companies in the stock market, is that quarterly decline or year over year growth. So we don't know. It's basically a question mark. The other data point we want to look at is the company's profitability. So as I scroll down, I get to the profitability. And again, the same story, right? And I'm going through this very rapidly because I believe a lot of you guys already know these things because of all the coverage of the company and what's happening. So let's just assume that the company does generate a significant amount of gross margin. But again, if you look at its quarter over quarter growth and gross margin, it's down 6%, almost 7% on a year over year and 3 year point of view. It's growing, right? So again, the same situation as we're talking about from a revenue point of view. There is trend toward downward trend, but if you look at overall, if you zoom out and if you look at a couple of years of history of the company, it's still growing from revenue and profitability point of view. The other part of our framework is about the companies. Does the company can it increase its earnings power, right? Typically, we look at earnings power when we're evaluating a company's ability to generate earnings through its return on equity, ROE. Return on equity is every dollar that the company has in its for its shareholder, how much of it becomes a return to its shareholder, right? So if I scroll down to the section on the stock card that we have things like ROE, it's part of our management effectiveness, because those are decisions that the management of a company make. We can get its return on equity, and scrolling down all the way to the return on equity section. Again, I'm telling you, it's the same story as we've been saying about revenue and about profitability on the return on equity as well. The company has some positive return on equity, but it's basically somehow negligible on a fiscal quarter, last 2 fiscal quarters ago. And then if you look at its actual year-over-year return on equity improvement, you see that it's actually improving its return on equity. So yes, there is a lot of negative stories about companies' earnings and profitability, but if you zoom out and you look at what it has been doing, it's actually been improving its return on equity. Let's go back to our framework. We basically went quickly on four of our framework, four of the things that we need to evaluate in our framework. And basically we looked at its market cap. We said it's pretty big, so it might be concerning to think it can actually become $26 trillion of market cap. Revenue growth, small on a quarterly, negative on a quarter over quarter, but growing on an annual basis. Earnings power, positive, but again, not consistent. And then we do want to, same story, I'm not going to go through this one by one because now you know how to get it from the stock part. So I just want to recap what we've learned from the company's basically financial reports. And let me make this screen a little bit bigger for you guys. Yeah. So free cash flow has gone down to almost negligible. So I put zero here, but it's not really zero. If you look at its quarterly earnings, it's about $137 million in free cash flow. But for a company that is used to generating billions of dollars, billions and billions of free cash flow, it is very, very concerning that it's free cash flow going down. Again, if you zoom out and if you look at the last few years, it actually has this positive track record of generating a lot of free cash flow. So it's almost from a growth, profitability, earnings power, free cash flow generation power, the company is almost it's the same story, right? Same story. Blip in the current situation, but zoom out, it's a good solid track record. And the last three metrics or criteria we look at when we're talking about a company's hardware fitness, I guess, is that whether we have an opportunity to buy this company at lower multiple. So this is again an interesting one. A few seconds ago, I did this math for you and said it is certainly possible to see that the company's stock price get half as of where it is right now. Right now, it's at a PE ratio of 8.7, almost 9. That PE ratio compared to S&P 500, which has a PE ratio of 17, 18, 19, something along that, it is quite cheap. But if you do this math that we did together a few seconds ago, the company's stock price can get half. So that's one thing to consider, and that's certainly possible. Now I want to show you the opposite of what's basically possible, and that's this math. So if the company's current revenue is $27 billion, right, in this quarter, multiply that by 4 and you get $108 billion in annual revenue, assuming everything stays equal. And then let's think that the company can grow its revenue between 3 to 5% per year for the next 3 years, right? So we're growing the 108 by 1.3 to the power of 3, the math, right? So it's going to get to the $118 billion in annual revenue. If we assume a price to sales ratio of 3.5, and that's not outrageous, right? It's 3.5 is quite an average of the market. We're going to get a market cap of $413 billion. Compare that to the current $260 billion in market cap, and there's a 58% upside. Right, so when we talked about at the beginning, this is the most uncertain company in the world right now in the stock market. It can get half by 50%, and it can actually have a 58% upside. So going back to our framework a few seconds ago, it's cheap based on PE and price to sales ratio, but we really don't know where the company can go from a direction point of view, so that it can even go lower. That's why it gets again another question mark. Down to the last two criteria of evaluating whether a company can be a good hunter bagger or not, the quality of leadership. So if you looked at our Tesla episode, I talked about the 4-part framework to evaluating a leader of a company or CEO's quality. Does the CEO have a skin in the game? Can the CEO bring a big vision? Can the CEO hire the right people in the right role? And can the CEO fund the company's aspiration? Those are the 4 criteria when you're evaluating a company's CEO or leadership team. And when it comes to Facebook or Meta, Mark Zuckerberg has a significant amount of skin in the game. Obviously, his wealth and his aspirations, more importantly. Maybe he's not as inspired by cash and wealth anymore because he's already independent. He's already quite wealthy. But if you look at his aspirations, he truly, if you listen to the quarterly earnings call and hear passion in his world, in his speech, when he's talk, he is quite determined to make this metaverse thing work. So not only he has a skin in the game from a financial point of view, but he has a skin in the game from a aspiration point of view. He has a big team, 50, 60,000 people, really good leadership team around him to help him grow his business. The company already has lots of capital, right? So they're generating cash or basically funding capital is not as big a deal for Facebook. And the big vision, what is bigger than being the first mover in the metaverse? What is bigger than being the first mover in becoming the leader of AR and VR, not only from a consumer point of view, but also in businesses. So the company can basically, when you think about Mark Zuckerberg, he's truly a good leader. Regardless of whether you hate him or love him, right? Forget about what you think about his character, but he meets the 4 criteria for becoming a good leader. And then the last piece is the competition. Is it as strong or not? So we already talked about TikTok, short format videos on YouTube, advertising spend out there under the pressure, lots of other options. Even Amazon is really getting strong in going after those advertising dollars. So for the current business, there's significant amount of basically competition. But first of all, the company has a lot of cash, but second of all, it's the only company I know or out there that spends billions of dollars in generating technology and building the future of metaverse. And that's an advantage. That's something to think about. If they succeed to turn these dollars into actual products and opportunities, that's a significant first mover advantage and head start for future of the company. So put this together, can Meta become a 100-bagger? Likely not. Just for the sake of, just because of the sheer size of the company where it is right now, although it is significantly lower, but everything else about it is, it's a question mark, right? You can see the downside and you could see the upside about it. I would not personally invest in it in my 100-bagger portfolio, but as always, let's have a conversation whether there is a place, whether there is a source for Facebook, for Meta to become the next 100-bagger story, where that 100x or maybe even 15x or even if 20x return can come from, right? So we talked about this in the past. 100-baggers are companies at minimum, at a core, are the companies that have improved, that have a way to expand their earnings. And where does earnings for Meta come from? Either it comes from growing its current earnings or improving its current earnings potential, or coming from or gaining a higher multiple for its market cap, right? Those are the 2 ways that a company's market cap could increase. So its current business, I'm very optimistic about it, because it's sort of like the story out there that say they're putting all of their money in the metaverse development, but if you listen to their earnings call and listen to what Mark Zuckerberg and their leadership team talking about, and if you look at their numbers in terms of increase in their spending on their recommendation engine, which is the core foundation of their advertising dollars, the company is actually spending significant amount of money on it. In the last earnings call, the last question that analysts asked from Mark Zuckerberg was very interesting. And if you haven't listened to it, go listen to the last earnings call. And the last question the analyst asked, and somebody asked Mark Zuckerberg, we're all worried about Facebook or Meta have too many bets, too many experiments going on at the same time. And Zuckerberg came back and said, yes, there's a lot of experiments, but the portion that we are spending on improving our recommendations, those are not experiments. Those are actually work that it just takes time for us to find the right optimal way of improving our ad agent and our recommendation engine, but it's going to work. And I truly believe that. So the company has certainly a way to improve its earnings from its current current business, which is advertising dollars on Instagram and WhatsApp and the core Facebook. And then the digital ad spend, it's gonna grow. We're just in this flip of economic situation that the advertising dollars are going down. As a matter of fact, just before this call, I checked, and it's expected the advertising dollars, digital advertising dollars, to grow between 10 to 15% per year in the next decade or so. So at some point, that growth is going to trickle down to Facebook's or the Meta's earnings. So I'm quite certain the company can grow its earnings or the potential of its earnings through improvements it's making in its current business, right? The part that I'm very uncertain about, and I don't know how long does it take, it's their investments in metaverse and bet they're making on VR and AR. But let's think about it a second. So the previous generation of large companies like Facebook, the previous generation, the reason they lost their leadership in the market is that they had this business that was growing very well. And then the competition, when the small startups came in, they didn't spend a significant amount of money on their R&D, and they lost their leadership in the market and their market cap as this new generation of technology companies came in, right? So Netflix did that to Blockbuster, Google did that to the traditional TV advertising. This is what you want to see from your big companies. If Facebook had not had spent this $20 billion and even more on their metaverse bet to build the future of interaction and communities and online and digital interactions, we should have all been asking ourselves, can the company continue to lead the market or not way into the next decade, in the next 2 decades, in the next 3 decades? What do we expect? Do we expect Facebook to just kind of focus on what they're doing right now, not to worry about building the future and then start paying us dividend? That's what happened to all the previous companies, the previous generation of market leaders, and they lost their leadership. So you do want to see these big bets. They can afford it. They have $50 billion or so in just cash and cash equivalent at the beginning of this. We looked at their quarterly earnings and their stock card. So this is what you want to see. If anyone can make it, it's Facebook or it's Meta. And they have the cash and they have the leadership, and they can do it. And that's what you would want to see from your market leaders. So yes, it's question mark, but I'm actually quite excited about seeing that. So the last thing I want to say to wrap up is that I own Meta, as I told you at the beginning, and I own it independently, but also through the SPY. And what I'm watching this company in the next quarter is that, can its AI and machine learning recommendation engine improve? We should be seeing that in the next quarter or in the next 2 quarters, right? In order to continue to hold this investment. Will there be, from a long-term point of view, will there be indications that their bet on metaverse in the future of augmented reality or virtual reality is going to pay off? So I'm not worried about how many Oculus they can sell in this quarter, but I really want to see significant amount of technological improvements from what they're building in their VR and in their sort of metaverse business. And overall, I keep holding to the stocks that I own. Metaverse, the stocks, Meta, the stocks that I'm owning, and I'm watching these few things about the company's future. That basically wraps up our metaverse, I keep saying metaverse, but Meta's analysis. If you've been watching live and if you have any comments or questions, please add them to the comment section. Otherwise, I would see you in the next 100 Bagger series live stream. It's going to happen probably, today is Tuesday, on Thursday, not Wednesday, basically on Thursday. And yes, looking forward to doing another of these stock analysis with you. Thank you very much, and see you in the next live stream. Have a great day.